Welcome back to the deep dive. Today, we are really getting into something fascinating. A strategic move so big, so honestly counterintuitive, it's shaking up the entire global building materials world. We're diving deep into Holcim AG, a giant, right? And they're at the peak of their game financially, but now is when they choose to, well, basically split the company up voluntarily. And look, this isn't just about cement or gravel. Not at all. This is about rewriting corporate DNA. A massive breakup, a really ambitious pivot towards, sustainability, high margin stuff, trying to shake off that old commodity player tag. Our sources, we've got a stack of detailed investment reports here. They call it a deliberate and profound strategic transformation. That's the exact phrase. So our mission today, understand the why and the how. How does a company doing, projected recurring EBIT over 5 billion Swiss francs for 2024, a stunning 19.1% margin.
Yeah, record levels.
How do they decide the best path forward is to chop themselves in two? We need to unpack the strategy, the money side, the green angle, give you, the learner, the whole picture.
Well, what's really interesting here, the core theme, I think, is this conscious shift, moving away from being seen and, frankly, priced by the market as just a volume player, just churning out cement. The goal is to reposition Holcim as much more value-focused, solutions-oriented, changing the whole risk profile, this entire split. It's engineered, really, to get what analysts call a structural re-rating.
A re-rating, meaning a higher valuation.
Exactly. They want to cut down that cyclical risk, the ups and downs inherent in heavy commodities like cement, and get the remaining business valued more like a specialty building provider, which typically trade higher. And to do it, they're making a huge sacrifice. Strategically, they're spinning off the North American division, which is incredibly profitable, to hopefully get a higher combined value in the end. It's that classic sum of the parts play.
Okay, so to really get how big this split is, we need to understand what they looked like before they decided to hit the big red button, right? The baseline.
Yeah, that baseline is crucial. It shows two things. One, they weren't doing this out of desperation, far from it. And two, they had the financial power, the muscle, to actually attempt something this big. So looking at the full year 2024 numbers, the combined Holcim, absolutely peak performance. They hit that 19.1% recurring EBIT margin you mentioned.
Right, and maybe we should quickly unpack that term, recurring EBIT. We hear it a lot. What does it actually tell us, and why is 19.1% so, impressive in this industry?
Good point. Recurring EBIT earnings before interest and taxes. It's basically the core operating profit before you factor in financing costs or taxes. And the recurring part is key. It strips out the one-offs, things like selling a big asset, major restructuring costs, stuff like that. So it gives you a cleaner view of the actual ongoing operational health.
Okay.
And for a huge capital-heavy company like Holcim to hit 19.1%, that signals incredible efficiency, great cost control, and crucially, strong pricing power. Even with all the global volatility and inflation, they could still command good prices.
They mentioned hitting their 2025 strategy goals 2 years earlier.
Exactly. That screams operational maximum. They were firing on all cylinders.
So let's break down that engine. Where was the money coming from within the combined company?
Well, historically, and definitely in 2024, the main cash machine, no question, was cement. That's the traditional heart of the business. It brought in CHF 13.2 billion in net sales. But the margin's the real story there. Cement delivered a 26.4% recurring EBIT margin. Industry leading.
Wow.
Yeah. Think about it, over a quarter of every franc or euro they made. Selling cement dropped straight to operating profit. That sheer profitability, that's what funded everything else. The strategy shifts, the acquisitions we'll talk about.
26.4%. That is staggering, especially when you compare it to the other stuff you need to actually, build things.
Precisely. You've got the other key parts, aggregates, so sand, gravel, stone, and ready-mix concrete. They're essential for vertical integration, controlling the supply chain.
Right, you need it all.
You need it all. But the financials look very different. Aggregates brought in CHF 4.3 billion in sales, decent margin, but much lower, 15.3%. Then you get to ready-mix concrete, the final product, right? Mixed, delivered just in time. It's a classic local business, high volume.
Okay.
Ready-mix did CHF 5.6 billion in sales, but the margin, tiny, only 4.5%.
4.5%. Why such a massive drop from cement's 26.4%? That seems like where the rubber meets the road, literally.
It does, but it's all about the business model differences. Cement is, it's a processed commodity. You can standardize it, ship it, get global economies of scale. Ready-mix concrete, it's perishable. It starts setting almost immediately, so the market is naturally fragmented, hyperlocal. You can't really ship it more than, say, 50, maybe 80 miles before it's useless.
Well, okay. Logistics nightmare.
Exactly. And that local competition crushes pricing power. Plus, you've got high costs, fuel, labor, trucks. It just eats away at the margins. So yeah, those lower margin bits, they drag down the overall picture if you're just focused on volume.
Which makes perfect sense why they needed a new growth engine, something different. Enter Solutions and Products, or S&P. This is the pivot made visible.
Totally. S&P is where they shift from selling, tons of material to selling systems. Think specialized roofing, advanced insulation, repair products, stuff like that. These are higher value offerings, often proprietary. They don't need the same colossal capital investment as a new cement plant, and they're less tied to the big economic cycles, right? People still fix roofs even when new construction slows down.
And the growth there has been pretty fast.
Phenomenal. It's the clear sign of the structural change they're pushing for. S&P brought in CHF $5.9 billion in net sales in 2024. The margin was 11.1%.
Better than ready mix, but still way off cement.
True, but it's a different kind of margin. And look at the speed. S&P went from just 8% of total sales in 2020 to 19% by 2022. They're scaling it rapidly. And yes, 11.1% isn't 26.4%, but it's seen as higher quality earnings than ready mix, more stable. This growth is basically the justification for the whole breakup strategy. They're using the cement cash cow to fuel this massive re-engineering of the business mix.
So that shift was already happening, and they had the financial strength to do it. But the really dramatic move wasn't just growing S&P, it was cutting loose the entire North American operation.
Which brings us squarely to the split.
Right, the spinoff. This is the big one. It's a planned 100% spinoff of the North American business. Slated for the first half of 2025, assuming shareholders approve, of course, key point. They're not just selling a piece of it. They're creating two completely separate, publicly traded companies. And the new North American company gets a name, Amrize, listed on the NYSE. Okay, my question, and I bet it's yours too, listening in, why? Why go through all the hassle, the complexity of a full spinoff? Especially when North America was doing so well. Why not just sell it off, take the cash, and fund the global pivot that way?
It's a really sharp question. And it gets right to the heart of unlocking value, not just getting a one-time cash injection. Selling it would trigger huge taxes, first off. And yes, they'd get cash.
Yeah.
But a spinoff, that creates two distinct investment stories, tailored for different investors.
How so?
Well, Amrize gets positioned as a pure-play North American infrastructure leader. That's critical because the U.S. market has these huge tailwinds right now, right? Massive infrastructure spending bills, the Inflation Reduction Act driving factory building, companies bringing supply chains back onshore.
Backshoring, yeah.
Reshoring. So a U.S.-focused Amrize can attract specific U.S. infrastructure funds, U.S. investors, who might not want the complexity of a global company exposed to, say, European regulations or emerging market swings. It's a cleaner story for them.
Okay, so it's about escaping that conglomerate discount we hear about. Let's maybe unpack that concept a bit more.
Sure. The conglomerate discount is pretty straightforward, actually. When you have a company that mixes different types of businesses, say, high growth, specialty stuff like S&P, alongside capital-heavy cyclical stuff like cement investors sometimes struggle, they find it hard to properly value the high-growth part because it's lumped in with the more volatile, capital-hungry commodity side. So the market often just applies a sort of blended, usually lower valuation multiple to the whole thing. The big, slow part drags down the perception of the fast-growing part.
Right. The discount.
The discount. So by splitting, they aim to break that. It's the sum of the parts argument. Amrize gets valued based on those solid U.S. growth trends and government spending, potentially a higher multiple, and the remaining new Holcim. The idea gets a higher multiple too, because its profile is now much more weighted towards those higher margin solutions and sustainability angles. The bet is simple. Value of Amrize plus value of new Holcim will be greater than the current value of the combined company.
But let's be clear about the immediate financial hit. They are spinning off their most profitable region. The starting point for the remaining company gets a lot smaller.
Oh, absolutely. Brutally honest. North America was the financial engine in 2024. This isn't cutting deadwood. It's removing the prize bull from the herd. So when Holcim restated its financials to show what the remaining business looks like the new Holcim, the numbers shrink significantly.
Okay, let's lock those key numbers in for everyone listening. The new Holcim baseline, post-split, starts with restated net sales around CHF 16.3 billion and recurring EBIT, CHF 2.8 billion.
That's the new starting line. CHF 2.8 billion in operating profit. Management has basically chosen to reduce its core profit base by, what, over 40%, all to chase this new strategy.
It really underlines the scale of the ambition, doesn't it?
It does. They're shedding a huge profitable asset, and the pressure is immediately on the remaining team to grow that CHF 2.8 billion baseline fast, not just to make it the difference, but to actually justify that hoped-for higher valuation. Which brings us to the strategy for what's left.
Right, so New Holcim, the ex-North America business, it's operating under this banner, Next Gen Growth 2030. Geographically, the focus has to shift dramatically now. Where are they looking for that crucial 3 to 5% average annual growth they need to make this whole thing work?
The focus sharpens onto three main zones: Europe, Latin America, or LATAM and Asia, Middle East and Africa, EMEA. But the growth story is different in each. In Europe, it's less about huge new building projects and more about regulation, actually.
Interesting. How so?
Well, increasingly strict environmental rules, carbon taxes, mandates for green buildings, they're basically forcing demand for higher-cost, sustainable building solutions, which plays perfectly into New Holcim's strategy and their eco-packed, eco-planet products we'll touch on, LATAM, that offers solid infrastructure and commercial building demand driven by demographics, urbanization. And EMEA is more that traditional emerging market story, rapid domestic growth, particularly in places like North Africa, India, and their existing strong business in Australia.
So a rebalanced geographic footprint. But the real core of this next-gen plan, the thing that defines New Holcim's future identity, seems to be this radical target for the business mix.
It is, and it's staggering. The goal is a 50-50 split in net sales. 50% from traditional building materials, the remaining cement and aggregates, and 50% from higher-value building solutions, roofing, insulation, repair, specialty concrete, the whole S&P suite.
50-50. That's not tweaking things. That's a fundamental overhaul where the money comes from, aiming to do that in just a few years.
Exactly, not evolution, it's revolution.
Why is hitting that 50-50 target so critical for the whole investment case?
It comes back to earnings quality and stability. Look, cement still throws off incredible cash, high margins, yes, but it's cyclical, very capital intensive. Building solutions, okay, maybe the gross margin isn't quite cement's peak 26%, but it needs way less capital spending, and crucially, it's generally more resilient. Maintenance, repair, niche stuff keeps going, even when big construction projects pause. So by hitting 50-50, they make the entire earnings stream more stable, less volatile.
So they can ride out the downturns better.
Precisely.
Right.
They're aiming for a company that can stay solidly profitable, even if the global construction cycle hits a rough patch. And that stability, that predictability, that's what's meant to justify moving away from low cement company valuation multiples towards the higher ones you see for specialty industrial firms.
Okay, but the ambition there, the execution risk must be huge. What are the big hurdles in scaling up that solution side so fast to hit 50%?
Oh, the hurdles are massive. Making cement is standardized, it's complex, but it's a known process. Scaling solutions mostly through buying up other companies. That means integrating maybe dozens of smaller firms. Different company cultures, different IT systems, different sales teams, often in different countries. It's a huge drain on management time and attention.
Right.
They're basically trying to morph from being a heavy industrial giant into like a sophisticated B2B solution seller. That's a totally different skill set, especially in sales and marketing.
And if they stumble on the integration?
If they can't integrate these acquisitions smoothly, quickly, if the costs get out of control, then the growth they bought just doesn't turn into profit.
Yeah.
The market, it'll hammer the stock. The whole re-rating story falls apart.
And that M&A, the buying up of companies, the roll-up strategy, that's the main engine driving towards 50-50, right? Can you give us a sense of the pace and the discipline involved?
The pace is just relentless. You mentioned the numbers: 27 deals in 2024, 28 in 2023. This isn't occasional tinkering. It's a high-speed, systematic acquisition machine.
So what does a typical target look like? What are they buying?
They're generally going after smaller, often privately owned, specialized companies. Leaders in specific niches, usually in fragmented local markets. Think roofing systems, high-performance insulation, maybe concrete repair specialists. Like they bought a U.S. company called OX Engineered Products, a leader in certain insulation types. Buying them gives Holcim immediate market share in that niche, existing customer list, maybe some unique tech, all in a high-growth area. They use their size and cash to consolidate these fragmented markets.
And the price tag. The source mentioned they buy these bolt-ons at around 8 times adjusted EBITDA. Why is that considered disciplined?
Well, that 8x multiple, especially when they say it includes expected synergies, the cost savings or revenue gains they plan to get, is pretty sharp.
Hmm.
because similar specialty building solution companies, if they're publicly traded, might trade at 10 times, 12 times EBITDA, maybe even higher.
Okay, so they're buying cheaper in the private market.
Essentially, yes. It's a form of arbitrage. Buy growth privately at 8x, integrate it well, run it efficiently, boost its growth, and hopefully the market eventually values that acquired business as part of the new Holcim at a higher multiple, say 10x or 11x, because the overall business mix looks better. And this isn't just about buying. They're also selling off bits that don't fit, divesting lower margin businesses or exiting certain markets like they did in Uganda and Nigeria. It's all about laser focusing new Holcim on the most profitable geographies and products.
Okay, let's shift gears a bit. Thinking long term about competitive advantage. Holcim seems to be trying to turn sustainability, which is traditionally a huge problem for cement making,
A massive liability, yeah.
into a commercial plus. For years, cement was just, gray powder, anonymous. But now it seems like environmental performance, the brand tied to it, is really starting to matter.
This, I think, is where the strategy gets really clever. For most old-school building materials companies, all this regulatory pressure on CO2 emissions, it's just a cost, a risk, a headache. Holcim is actively trying to flip that narrative, turn it into a commercial tailwind. They're finding ways to actually make money from being greener through what people are calling a green premium.
Okay, define that green premium. How exactly do they monetize cutting carbon? Are customers paying a lot more?
It's not always a massive price hike on everything, but it's about achieving durable, consistent pricing power on certain products, which is incredibly valuable. What we're seeing is big infrastructure projects, government contracts, even large private developers. They're starting to write tenders that specifically ask for, or even mandate, lower carbon concrete and cement.
To meet their own green goals.
Exactly. They have their own ESG targets or regulatory pressures, and they will pay a bit more, maybe 5%, maybe 15% more for concrete or cement that helps them meet those goals. Holcim isn't just selling cement. They're selling a solution to a compliance headache.
And we see this in their specific product lines.
Absolutely. Look at their branded solutions. EcoPact, that's their range of green concrete, and EcoPlanet, their green cement. The scale here is what's really striking. These sustainable products, they grew significantly. In 2024, they accounted for 36% of Holcim's total net sales.
36%. Wow, that's up quite a bit.
Yeah, up sharply from 30% the year before. That kind of growth tells you decarbonization isn't just a PR exercise or a cost center anymore. It's becoming a core commercial driver for them.
And underpinning this commercial success are some serious tech investments, particularly this move towards circular construction. Tell us about their EcoCycle technology.
Right, EcoCycle. It's their proprietary process for taking construction and demolition waste, old concrete, rubble, bricks, that sort of thing, and processing it so it can be used as raw material in new building products, replacing some of the traditional virgin materials like clinker and cement.
So recycling on an industrial scale?
Pretty much. And it tackles two big issues at once. First, it cuts down their need for virgin raw materials, which helps control costs and reduces environmental impact. Second, it provides an answer to the huge global problem of what to do with all that construction waste. And their target here is incredibly ambitious. They want to nearly triple the amount of recycled material they use, aiming for 20 million tons a year by 2030.
20 million tons. That's
Yeah.
huge.
It's enormous. Requires massive investment in waste collection, processing plants, logistics. It shows they see circularity as a core, scalable business advantage, not just nice to have. It also gives them a bit of a hedge against volatile raw material prices.
Okay, but we can't talk cement and greening without hitting the really tough part. The emissions baked into the actual chemical process of making cement, that's where carbon capture, usage, and storage CCUX comes in, right?
Absolutely. CCUS is the big frontier. And honestly, the biggest capital challenge for the entire cement industry to get anywhere near net zero. See, when you heat limestone to make clinker, the chemical reaction itself releases CO2. Doesn't matter what fuel you use, coal, gas, biomass, you still get those process emissions. The only way to deal with them is to capture the CO2 before it hits the atmosphere.
And Holcim is actively working on this.
They are. They're running, I think, 7 major CCUS projects right now, which puts them right at the forefront globally. But you need to understand the scale here. These aren't lab experiments. We're talking about building huge, complex chemical plants bolted onto existing cement kilns. They need enormous amounts of energy themselves, sometimes using up to 30% of the whole plant's energy. And then you need somewhere to put the captured CO2, deep underground storage, specialized pipelines. Getting permits is a whole other challenge.
Just the cost of those 7 projects must be astronomical. What does betting so heavily on CCUS tell us about their long-term view on costs?
It tells us they're willing to shoulder massive capital risk now to secure their competitive position later. By moving early, they hope to master the technology, maybe lock up the best geological storage sites, potentially influence how regulations develop. Because if carbon prices keep rising, especially in Europe with the ETS, the cost of not capturing emissions could eventually become even higher than the cost of building these plants.
So it's like an insurance policy.
It's partly that. An insurance policy against future carbon costs. And it's also a way to guarantee they can supply truly low-carbon cement to those customers willing to pay that green premium we talked about. This technological lead, even with the cost, becomes a key part of the valuation story for the new, focused Holcim.
Okay, let's circle back to the financials, the engine room, really, that makes this whole massive strategic shift even possible. We talked about that impressive margin expansion, 15.9% in 2020, up to 19.1% in 2024. How did they pull that off, especially with energy costs and inflation running wild?
It really looks like textbook discipline management. First, that value over volume strategy we mentioned. They prioritize price increases to protect margins rather than just chasing tons at any cost. Second, the business mix was already starting to help, right? That growing S&P segment with its higher value naturally lifts the average margin for the whole group. But the really impressive part financially was the operating leverage they showed in 2024. Operating leverage is when your profits grow faster than your sales. Think about this.
Yeah. Net sales in local currency grew just 1.3%. Pretty modest. But recurring EBIT in local currency, that grew by a huge 10.8%.
Wow, big difference.
Massive difference. It means they squeezed incredible efficiency from their existing operations. They control costs so tightly that almost every extra dollar of sales drops straight to the profit line. Huge profit growth from very little sales growth. That's operational excellence.
And that efficiency shows up in their return metrics too, right? We noted return on invested capital, ROIC, at 11.2% in 2024, and normalized return on equity, ROE, near 16%. These aren't just numbers on a page. They tell you how well management is using the money they have.
Exactly. An ROIC of 11.2%. That's solid for this kind of heavy industry. It's well above their likely cost of capital, meaning they're creating value with their investments. But for a capital-hungry business like this, the real acid test is cash flow. How much actual cash does the business generate? And Holcim is consistently known as a cash machine.
Yeah, the numbers were pretty stark there too. Free cash flow hit a record CHF 3.8 billion in 2024. That was the 5th year in a row over 3 billion. That reliable cash flow is what funds everything, the strategy, the M&A, the decarbonization.
And here's a really interesting point for you, the learner, when you're assessing the quality of those earnings. Let's look again at those restated 2024 numbers for the new Holcim baseline. Cash flow from operations was about CHF 3.1 billion, but net income, the bottom line profit, that was CHF 1.5 billion.
Hold on, cash flow from operations was double the reported profit? How does that work? That seems weird.
It seems weird, but it's actually a really positive sign in this kind of business. It mostly comes down to accounting rules, specifically depreciation and amortization. Think about it. Holcim built a huge cement plant maybe 20 years ago. They paid cash for it back then. But accounting standards say they had to deduct a piece of that original cost as an expense on their income statement every year for decades. That deduction is depreciation.
Even though no cash actually went out the door this year for that past expense?
Exactly. It's a non-cash charge, a ghost expense on the income statement. And because cement plants, quarries, all that heavy equipment is so expensive, these depreciation charges are enormous for Holcim. They make the recorded net income look smaller than the actual cash generated by the day-to-day business. So seeing cash flow from operations significantly higher than net income, that tells you the reported earnings are backed by very strong real cash generation, gives them huge financial flexibility.
Okay, that makes sense. So with all this cash pouring in, how does management decide where to put it? What's the capital allocation playbook?
They're pretty clear and disciplined about it. Priority number one is always reinvesting back into the business. That means funding organic growth projects, supporting those big CCUS initiatives, and, crucially, doing those value-adding M&A deals, the bolt-ons for the solutions segment. Priority two is keeping shareholders happy with a progressive dividend. Growing it steadily over time gives investors confidence. And only after those first two priorities are fully funded do they look at things like opportunistic share buybacks or maybe very large but non-core strategic acquisitions, though the focus now seems clearly on the bolt-ons.
And they're definitely delivering on the shareholder returns piece, even during this huge transformation. They proposed bumping the dividend by 11% up to CHF 3.9 per share, and they keep announcing share buyback programs, like the recent CHF 1 billion one.
Yeah, they're walking that tightrope, funding a massive, ambitious, maybe risky transformation while still giving attractive returns back to shareholders right now. It takes strong cash flow to do both.
All right, but for you, the learner, wanting that balanced perspective, we absolutely have to talk about the risks. This is a complex strategy, and things could go wrong. Despite the pivot towards solutions, new Holcim still has that big chunk exposed to economic cycles, right?
Absolutely. That cyclicality doesn't just disappear overnight. That's the persistent challenge. Even if they hit 50-50, half the business is still fundamentally tied to construction activity.
So what happens if interest rates stay high globally for longer? What's the impact?
Well, high rates make borrowing more expensive for everyone building stuff. Commercial developers, home builders, even governments funding infrastructure. So demand for building materials could stall globally. That puts pressure on volumes, obviously, but also on pricing power, even for their fancy green products. Now, the S&P side focused on repair and remodeling might hold up a bit better.
Right, people still fix things.
People still fix things. But a really deep global recession, that would inevitably hurt the cash engine of the remaining cement business, and that would definitely slow down the whole strategic plan. Funding gets tighter. Then you've got execution risk, which is kind of two prongs here and maybe the most immediate danger. First, the spin-off itself, just technically pulling it off.
It sounds incredibly complex.
And it is. You're creating two completely separate corporate overheads, untangling decades of integrated IT systems, and a really critical piece is how they allocate the existing debt between Amrise and New Holcim. Get that wrong. Or mess up the operational separation. It could instantly destroy the value they're trying to unlock. Big time.
Okay, that's the risk in the separation itself. What's the other internal execution risk for New Holcim?
It's failing to deliver on that aggressive growth plan, specifically the 50-50 target. We talked about integrating 27 companies in a year. That's a massive management challenge. If they stumble on integration, if the costs are higher than expected, if the synergies don't materialize, the growth in solutions falters. And if the market starts to think, maybe they can't pull off this pivot, investors will just go back to valuing them like a basic cement company.
And the whole re-rating thesis collapses, leading to multiple dilution.
Exactly. The hope for higher valuation vanishes. And finally, related to the green strategy, that advantage comes with a cost that needs careful handling.
The regulatory cost, you mean?
Yeah. Carbon pricing, like the EU's emissions trading system, the ETS, that's a real direct cash cost for emitting CO2. Holcim's strategy is to pass that cost along via their premium green products, EcoPact and EcoPlanet. But what if demand softens? Or what if regulators tighten the screws faster than Holcim can raise prices or implement solutions like CCUS? Then the financial burden of decarbonization, including paying for those 7 huge CCUS plants, could really start to weigh on profits and returns long term.
Okay, so given all this, the strengths, the strategy, the risks, how should we think about Holcim's valuation now and where it might go after the split?
Well, today, the combined Holcim generally trades at a premium compared to some peers. That 19.1% recurring EBIT margin. It stacks up well against competitors like CRH, which is similar, or Heidelberg Materials, which has a lower margin. Historically, Holcim's efficiency has earned it a higher spot in the sector's valuation range, but the post-spin valuation, that's the $1 million or maybe $1 billion question. Investors will have to value two separate companies. Amrise based on U.S. infrastructure, U.S. growth. New Holcim based on its global reach, its success in solutions, its sustainability leadership. The entire financial rationale, the whole point of the split, rests on the belief that the market will value these two clearer focused stories more highly in total than it values the current, more complex combined entity. They are betting the farm on that shift in market perception.
Okay, let's try and boil this down into the two potential futures for the learner. The bull case versus the bear case.
Right, the bull case. That's the perfectly engineered re-rating. The spinoff goes smoothly. Amrise immediately gets a strong valuation fueled by U.S. infrastructure spending. New Holcim executes flawlessly on the 50-50 strategy. S&P grows fast. The green premium holds up. Pricing power remains strong. They deliver consistently superior returns, and the market rewards them with that higher specialty company valuation multiple. Strategy validated, value unlocked. And the flip side? The bear case. The bear case is, it's just a bridge too far. Maybe a sharp global construction downturn hits harder or lasts longer than expected, overwhelming the solutions buffer. Or the sheer complexity bites them. The spin-off causes operational chaos or unexpected costs. Integrating all those acquisitions proves too difficult. Margins suffer. And critically, perhaps the long-term costs of truly decarbonizing cement, getting CCUS built at scale, potential financing hurdles, regulatory shocks, prove too burdensome, preventing them from ever achieving that premium valuation multiple. The ambition outweighs the execution.
So fundamentally, Holcim is using its current strength, its cash cow, to fund a massive, inherently risky pivot away from being just a commodity player towards something specialized and sustainable.
Exactly. The risk is definitely proportional to the potential reward here. It's the high-stakes game. Hashtag outrosom.
Well, this has certainly been a deep dive into a truly fascinating, almost unprecedented corporate transformation. Holcim is taking the huge, reliable cash flows from its very profitable cement core, that 26.4% margin engine we talked about, and using it to engineer an escape from commodity cycles and perceptions, leveraging this massive split of North America to pour money and focus into building a future that's higher margin, more solution-focused, and built around sustainability.
And maybe to leave you with one final thought, something to chew on. Consider the leadership dynamic here. Jan Jenisch, he was the CEO who drove this whole transformation, the margin improvements. He moved to chairman of Holcim in 2024.
Yeah.
Okay. But he's also slated to be the chairman and CEO of Amrise, the spun-off North American company.
That's unusual. Both roles.
Very unusual. Normally, you'd expect a cleaner break. So what does this dual leadership, with the architect of the whole plan staying firmly in control of both pieces, tell you? Arguably, it's the strongest possible signal of just how committed management is to making both New Holcim and Amrise succeed independently. It suggests that ensuring a clean split that genuinely unlocks value, making the sum greater than the parts, is the absolute top priority for the entire leadership team. It's a powerful statement of belief in the strategy, wouldn't you say?